Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, April 25th, 2017. I'm going to go over a couple charts, only three, maybe four charts here today. We'll keep it relatively simple, and I wanted to talk on just really one topic. It's a topic that I mention a lot. It's something I incorporate into my trading, and that is to use divergences to identify market inflection points. Um, Before I get into that, because there does seem to be some confusion sometimes on the site, um, whether I'm looking for a divergent low on a stock or an index or a sector to be bullish, or a divergent high on the stock index or the market. That divergent high in the market. I'm a swing trader. I am an investor in my long-term accounts, but first and foremost, I'm a swing trader. Swing trader trying to capture the short-term trends in the market, days, weeks, sometimes a few months. So make no mistakes about it. Pointing out divergences in the market. Although I will say, this market, it's been well over a year since it overtook moved into the slot of the second longest bull market in history. And this, I promise you, within the next, I can't say exactly when, my strong inclination is within the next year, one of these divergent tops, look just like any other one, will be a lasting top that starts more than a pullback, ranging, as you can see, these pullbacks here range from some of these small ones are 3% or so, but about 5% to 20% in the last couple of years on these divergences. So that's what I wanted to talk on. And again, by identifying divergent tops, it doesn't mean that the world has to come to an end, that the market must fall 50% from that divergent top, but it is a guide. And here's the point I'm trying to impress, and I say this often. Much more often than not, negative divergences play out for correction, such as positive divergences play out for a trend reversal and a rally. Much more often than not is far from always. Always means 100% of the time. Much more often than not, if I had to define it from my experience, I would say easily 90% or more if divergences are used properly. Now, I'll talk on those, how I use divergences. We'll get to that here in a second. If they're used properly, I would say at least 90% of the time they play out for a tradable trend reversal, whether you're going long or short, whether it's bullish or bearish divergences. And so what I've done on this chart is I went back. This is a 2.5-year chart of the Nasdaq 100 daily time frame, 2.5 years of price history. And I painstakingly went through this chart and highlighted every single divergent high. Now, let's define that. People might use divergences different. My go-to indicators for divergence are the RSI 14 to be specific, and either the MACD or the PPO. They'll work very similar, but when you have large price swings, a PPO will do a little bit better job. So I've been using that more on the daily charts lately. But again, they'll mirror each other. They're very similar, and I have the same settings on the PPO, the 12/26/9. So what you see here, the dotted lines note each divergent high, and when I use divergences, I'll often talk about a series of consecutive divergences, and that's what we had here. These are what I call micro divergences, these smaller divergences. From this point to this point, for example, we had a divergent high. You can see the PPO making a lower high, the RSI making a lower high against prices making a higher high. That was followed by a 4.5% drop. Then we went up from there. The market continued, and that was a relatively minor pullback. You could certainly trade it. I mean, if you're trading E-minis, the NQ mini futures, whether you're trading just straight QQQ short, who wouldn't take a 4.5% profit in just a few days? That didn't take very long, maybe a week or two. But the market continued to go on to new highs. And this is what I see. This is a pattern, and this is where I've tried to explain, to people that, these divergences, they don't have to play out for a 20% drop every time. You can trade these for a quick pullback in the market, even during an uptrend, just like you can trade in a downtrend. You can play the pops, and those are some of my favorite trades. In a downtrend, I like to play oversold, positive divergence, bullish chart patterns, reversal patterns. So here's your divergences, a 4.7 drop next, and remember, this was a series of consecutive divergent highs, with this one first, Then we went from there, market went higher, and these are marginal new highs, meaning just slightly, only, anywhere from 0.5% to maybe 1% or two, couple percentage points, 2, 3. Market continued higher. After that, went up to this. Oh, I should say there was a divergence here, and that's what I said. I noted every little divergence on here. So again, you're seeing different lines. They're marking some of the what I call micro divergences, if you will, the smaller divergences within the larger divergence. And so those micro divergences culminated here. If I look at, let me clear these lines out just to kind of, somebody asked me the other day to maybe do a video on charting and things like that. And this is how I'm looking at divergences. So now I'm ignoring the other lines and I'm looking at one powerful series of consecutive divergences. At that point, those divergences, there's a couple things we noted. Number one, we had, again, a marginal new high. However, this one was pretty convincing. I mean, very convincing. I remember it back then. Bullishness was rampant through the roof because we had a near vertical rally, very strong rally after that last correction, only a 5% pullback in the market, rallied up, went on, took out the highs, market went to new highs, everybody was happy, bulls were happy, but that was a divergent high, and that's what I pointed out. That divergent high led to the biggest drop that the Nasdaq 100 had since this entire bull market, since going back to 2009, March of 2009, dropped almost 20%. So almost the official, criteria for a bear market had it dropped just, another percent or so. Either way, it's a sizable drop, and the thing is that stocks fall much faster than they rise in just a matter of weeks here, a couple weeks, a few weeks, maybe a month or so. We wiped out, as you can see, everything to the left of this chart. We wiped out many, many months of gains in just a matter of weeks. And that's typical, and that's one reason I love short side trading. Market went on from there. It was a very sharp correction, so we had a pretty sharp rally. Again, what happened? What marked the top? This was a top. I don't know if you can make it out. There's a little peak high, a slightly higher high. There's divergence right there. It wasn't a very large divergence. Sometimes it doesn't take a lot. However, it was very steep. If you note on the PPO and the RSI, they were severely lagging. And that was followed up with another 18% gain. So, last couple years has had tremendous opportunities for swing traders, whether on the long or short side or both. If you're flexible, you can do both. Fast forward, you can see another divergent top here, very small minor divergence, still good for an 8.6% drop. Yep, 8.6 from the peak to the lows. And before around the election time, now the markets were a little quirky here. This is one of those instances where the fundamentals or the news trump the charts. No pun intended. I know that one's been used many times, but that's what we had here is the Trump pump. A sell-off leading into the elections, and then a strong rally afterwards. I did want to highlight that I made an effort to show every divergence on here, and this right here, this one is the one divergence that I will say in this 2.5-year span, and they're all marked, including a lot of micro divergences on there, the one that didn't play out. Now, technically, it did play out for a 2.8% pullback from that divergent high, but that's not commensurate with the scope of this divergence. This was a series of smaller consecutive micro divergences. You can see drawn down here. We had a couple. The first one was good for a 3% drop. Market popped, went just a hair higher, made a marginal new high, and then dropped almost 6%. So it was a respectable drop, certainly tradable. And that was right into the elections. But then the elections kicked in. We put in another divergence high. So there's the one instance out of the last 2.5 years where a divergence that I expected, and I will tell you now, I didn't expect the market to rally as much as it did. That one did not play out for what I would expect it to. I have a dotted line here. If you're wondering what the dotted blue line is there was divergence. The PPO made a slightly lower high than it did back here. Which is negative divergence on the PPO. However, we did not have negative divergence on the RSI. So when you want to, as I said, using these divergences, I like to see them on both indicators. We didn't have it on the RSI, so therefore that's really not an unofficial, if you will, or not a divergent high because the RSI made a new high, clearly a new high. In fact, it made the highest high in years. Okay, so now I've gone over the history of divergences, how they play out much more often than not. Let's talk about today. Fast forward to what's going on right now. A couple of things. We have a couple of small micro divergences. We had one from this point, the high peak in the RSI to this low peak, and you follow the PPO down, you'll see that as well. That's marked right here, and that was good for a 2.1% pullback in the market. The market eked up, and again, we're talking the Nasdaq 100, which really isn't the stock market. I've gone over that ad nauseum lately. The Nasdaq 100 is really a tech ETF with Amazon and in there. It's a big top-weighted component. Everything else, this mirrors the XLK technology sector because of the tremendous overweighting of technology in the Nasdaq 100. But with that being said, it's everyone trades it, and it's certainly the leading index. And until the Nasdaq breaks, the market's not going to break. So that's why I'm spending a lot of time on it. So there it is. You have 1-2 divergent highs, each playing out for little corrections so far, minor little pullbacks, and now this new high. In fact, we put in a new high yesterday. We followed through today on a big up candlestick. That is simply another divergent high. Now, I need to make clear, I talk about this often when using divergences. I have what I refer to, and I've never seen this written anywhere, it's just something I've used, a term I use over the years, confirmed and unconfirmed divergences. These are unconfirmed. What I mean by that is the RSI is still pointing up, and so is the PPO. Therefore, the potential exists if they continue to move higher and they take out these previous reaction highs right here and here, we no longer have divergence. Those divergences will be what I call burned through or negated, taken out. So right now, this is only potential divergence. In my book, confirmed divergence is when we get a bearish crossover on the PPO. PPO starts turning down. That's not the right tool. But both the PPO and the RSI head lower, then that divergence will be confirmed. I had put a blue line there, just suspect maybe that's where it happens. I don't know. That's what I'm trying to tell you. Divergences are not sell signals, and I say that many, many times. They are not at all anything remotely close to sell signals. They are a heads up that a trend reversal, a likely trend reversal, will occur soon. What are your sell signals when coupled with these divergences are support breaks, trend line, key trend lines, horizontal price support levels, things like that. Also, you can throw in bearish candlestick reversal patterns, other things that are high probability sell signals. And the more evidence you have, the more likely it is that you're going to have a nice correction or a rally if we're using these in reverse, looking at bullish indicators. So there it is. These lines can go up, and as long as they don't take out the previous peaks, so it's just a matter of how much a market will go up. I've already shared the key support levels I'm watching. Let me also just bring up another point if I didn't mention this earlier. Okay, so I made the point that, it's funny because new highs on face value by most textbooks are bullish when your market breaks out to new highs. But in this case, these new highs, in every single instance that we had a divergent high and we made a marginal new high, they were excellent shorting opportunities, not times to go long. And that's what I'm trying to point out right now. And that's why I haven't abandoned my bearish case yet, because this is a divergent high. Still potential, but it's a divergent high. Now, there are times, such as right here, when we didn't have any negative divergence. You can see the PPO. This was the previous reaction high. The PPO had taken that out. So that also led to one of the most powerful rallies that we've had in years. So now I'm making a mess of this chart. And you can go back, and there's other times. So these are the highs. So I want to make clear that every new high isn't a reason to be on alert, not to take a breakout. You look for those highs that are lacking any divergence. But if I have a breakout to new highs with negative divergence, that is a new high that I would rather sit back. And I can tell you this now, I'd rather watch this market run 10% without me if it wants to do that. I don't think it will. I think it's going to look something like this. We've already broken out, and I would put good money that sometime this week, being that it's right after options expiration. Looking for the OPEX fade. We had the ramp holding the market up into OPEX last Friday, and I think we'll see that reversal soon. We'll have that confirmed negative divergence, and then bottom line is I'm looking for a pullback at this point based on the divergences of much more than 2.1, 2.3%. Somewhere on the lines if you take the average of any of these. And again, right now, this little ramp right here, it's been very powerful the last few days. The closest thing I've seen to that in years was back in 2015. Now this one was a little bit more, but you see that powerful ramp straight up and took us to new highs, blew out the last of the shorts. And I think that's what's going on here. So there's my views. I'll just look at a couple other charts. I've spent the bulk of the time, bulk of what I wanted to cover I did here on this NDX chart. Let's just look at the SPY. One other chart that I want to show you on market breadth, and then I'll wrap it up there. Okay, just real quickly, since I don't want to beat a dead horse, the charts will look very similar. This is the S&P 500, and also 2.5 years. Again, you can just freeze the video, make sure you're looking at the video, and click the full size. View the video in full size, full screen mode is what I'm trying to say here. But there it is. All those micro divergences, smaller divergences, 5.5% drops, 3% drops, but a series of consecutive divergences. Market actually peaked out here, made equal highs. That also gives you negative divergence when you have the equal highs there. I put 4.3 because it was, I used that in purple. It was slightly lower. I think it was a few basis points, but a roughly equal high. Either way, so that was a top or that was a top. That's my point, double top. And so measured this 15.3% drop in the S&P 500. Remember, the Nasdaq's a higher beta index. The S&P 500 is much more diversified. You have utilities, you have healthcare stocks, which the Nasdaq 100 is lacking, things like that are defensive issues that aren't going to fall as much during a correction. So that's why the Nasdaq dropped almost, or the NDX dropped almost 20%, but the S&P only dropped 15. But there it is. Either from that peak or that peak, they're the same peak, and down to the lows, a 15% drop. Now here's another thing too, guys. Sure, we've had a heck of a run in the Trump pump. It's been a nice run, but the market has gone for the last, this is a 2.5 year chart. So here's 2 years right here. This is about 2 years of sideways trading action. The market back in November, or even after November, right around the beginning of the year, was just barely where it was almost 2 years ago. So we've been in a go nowhere market, a trader's market. Yes, now we're, looking at possible new highs. So far, the S&P 500 peaked on March 1st. That's been the top. We've pulled back a mere 3.1%. We had divergence on the PPO, but not the RSI, because the RSI made a slightly higher high. But again, all the divergences are marked here. This is what I wanted to get to now. Here's the current divergence. It's potential divergence. That's why I have the line drawn. It could stop here today. Well, no, I take that back. It can't. The S&P 500 has to make an equal or higher high. So it has to either match the March 1st highs or make a higher high in order to have negative divergence. So there it is. Now, here's the thing. The S&P 500s are already topped. So if it turns back down before making it, then it's safe to say in hindsight, we can't say with certainty right now. Oh, we can say right now that was a top so far, but it's only been a 3.1% pullback and we're close to those highs now. But if it tops, again, it's all about the Nasdaq. That's why I spent a lot of time on the Nasdaq. And I just wanted to share that here as well. Here's the S&P 500 made a new high here, and then at this point it had burned through the divergences at that point, taken out that previous high, made a new high here on the RSI. And so, we had a clean run after the elections. And I think that's all I wanted to really cover on there. You can, like I said, just watch it. If the market wants to go on a rally for a few more weeks, the point I'm trying to impress here is that it may have already topped March 1st, but if it hasn't, until and unless we take out these previous highs right here and here on the PPO and RSI, if the market makes a new high, it's going to do so almost certainly on a divergent high. Okay, one more chart, and maybe if there's a minute or two left, I'll just touch on the IWM, the small caps. I know a lot of people like to trade those. This is the, and I've posted this on the front page recently, but this chart just speaks volumes to me, as does all the various percent of stocks above their 50 and 200-day moving average. This happens to be, if you look up top, the Nasdaq percent of stocks trading above their 50-day moving average. I put up the Nasdaq stocks above their 200-day moving average, the NYSE, the S&P 500, both the 50 and 200 days. It's all the same. What we're seeing here now, this, keep in mind, goes back 13 years. I can go back longer. All you're doing is it makes the chart harder to read. We go back 13 years. We can see leading up to the bull market top in 2007. Let's walk through this real quick. You probably already looked at this on the front page, but here's the first divergence. And again, what we're comparing, this is the Nasdaq composite right here, using a simple line chart. Um, and this is the percent of stocks trading below their 50-day moving average. So if you had, you're never going to see this at zero. It'd be very rare because that would mean not a single stock is trading above its 50-day moving average. That almost happened. We got down real low, down around the 5 level, at the late 2008 when the Nasdaq 100 bottomed. But nor are you going to ever see them all above 100% or at 100%. That would be virtually impossible, or not impossible, but rare. So the range, as you can see, the extremes are about 80 down to, we'll call it 10 or 20%. And but the point is, the takeaway from this is the divergence. In a healthy market, you want to see broad participation. So if you take the universe of stocks in the Nasdaq composite, and you want to see during a strong advance, you would think and suspect that more than half of the stocks are doing better. Now, we just recently dipped way below that. Even while the market was at new highs, we hit as low as 40%. We were even lower before. But what I look at, the main thing I'm looking at on this chart is using divergences in a different way. A minute ago, we were looking at price and momentum indicators and oscillators. The PPO is a momentum indicator, and the RSI is what we call a price oscillator. Oscillators are just bound by a finite range. The PPO, the maximum is 100. I'm sorry, the RSI, the max is 100, the minimum 0. Cannot go below those. Whereas a PPO, it's unbounded. There's no bottom or top to the range. It can do whatever it wants. So that's the difference between an indicator and oscillator. Okay, these are the divergences. You see two lines here underneath, the smaller line, then the sharp drop off. That notes this divergent here, and that was good for a 15% drop. That was a smaller divergence within a much larger divergence that then led to a 50% drop, which is the bear market from the October 2007 high down to the March. Well, the Nasdaq, the NDX, I should say, actually bottomed here in '08. Where is it? Right here in October of '08. The rest of the markets bottomed in March of '09. And then you can see the other divergences. So there it is, guys. They're drawn out. I don't have to explain that much more. And without fail, if I missed anything, please point it out on the site. But without fail, each of these divergences led to substantial corrections. And again, now we're not talking. A minute ago, I was on a daily chart showing you divergences that were, micro divergences, small divergences. This is a weekly chart, meaning it's represent weekly action, not daily action. And so these are showing you the much larger, powerful divergences. These are the ones where you want to make good money on a short, swing short position. And as you can see, they're averaging so far, the average has got to be at least 20%. If you take the 50% drop, the 20%, 13, 12%, 10%. And I also mentioned that when I put this up. A correction is defined by a drop of 10% or more. Something else to note, guys, this greatly understates the drops. What I mean by that, well, this is a line chart. If you put up a candlestick chart, you'll see intraday lows on a lot of these plunges. Here's a good example. Back in 2015, let me just show you a chart real quick. I'll click over and show you a chart of the Nasdaq 100 via QQQ. Okay, here's the Qs, and I'll even put up the Qs. We had a flash crash. It's an ETF. We had a flash crash on the market too, but the Qs went down more than the NDX. So to try to do this as accurate as possible, I'll just look at the NDX, the actual index itself. Let me get a clean board. Let me get that out of there. All right, so here's that crash. This was in late mid 2015, and that's that drop of about 19% that I already covered on the NDX. And you can see we went much lower than the subsequent drop. But when I use a line chart, here, I'll do it here for you. Edit chart properties, price style, candlestick, go to line. Voila, all of a sudden, this looks like the bigger drop. So again, I just wanted to, it's a little charting tidbit for you guys that this understates some of these drops, because in many cases we had a long candle. I know that happened down here on the lows in 2008, followed by a reversal. Line charts only show you the closing value. So you could have dropped, the index could have dropped, 4 or 5% or more during the day of the low, and it wouldn't be reflected here. So, these are drops you could have caught, even if you didn't nail the bottom, even if you got out. There it is. So I look at this chart and 13 years of price history without fail, every single divergence. And again, this is using not just this is looking at market breadth. This is looking at the percent of stocks that are trading above their 50-day moving average, which has been plummeting with these very steep divergences. In fact, it's a sharp drop-off. Look at the divergence line. We had divergence at this point here, and then an even sharper drop-off in the NAA 50R, similar to what we had in 2015, which was followed by one of the largest drops, a 20% drop. Yeah, it looks like we had a 21% drop there if I measured it right. I don't see why this is going to be any different. And one more thing, then we'll wrap it up here, is you notice these are these little thrusts that just they ramp up the bullishness, the giddiness in the market. Look at the top. Look at what happened. We had a little correction. There was a top there. We had a divergent high right there, if you can look where the pencil is. But then we had that ramp, a very sharp ramp last minute, identical to what we have right here. Let's see, we had a similar ramp there. We certainly had a last minute ramp right there, but this is similar to the top in 2015 right there with this last minute ramp to new highs. Still a divergent high, not even close to not being a divergent high. For these divergences to be taken out, that means the market will have to continue to rise, and we'll have to see the NAA 50R come up over, at least take out these highs right here. But this is the previous high right there. And unless that's taken out, we have significant divergence that just says the same thing I've been saying all along. It's those key stocks: Facebook, Apple, Amazon, Microsoft, and Alphabet. Simple GOOG. They need to go for the market to go. Promised you guys one thing for you small cap traders. Let's go back to a candlestick chart. We'll look at the small caps, and then we'll wrap it up. IWM, same story with everything else. Here's IWM. It tried to make a run at the March 1st highs. They, like everything else, it topped on March 1st, closing at 140.36 with a high of 140.86. Today we hit a high of 140.88, closed at 140.24. So still under that closing high. Call it a double top if you want. Call it whatever you want. Call it the IWM. Let's just say it takes out that high. Here's what's going to happen. If it takes out that high, which it may or may not, if it turns down here, it's a double top. I don't know. I can't predict when it's going to reverse. I can just tell you things are getting very frothy and very typical, much more typical of a top than a breakout in a sustained run. I'm talking 10% or more from here. So here we go. We extend the divergence line, and we extend this divergence line. You can see we had divergence right here at the March 1st highs. That divergence did play out for a correction. It played out for a pretty healthy correction in the small caps, both in price and time. Now, any new high from here, even this roughly equal high, is a divergent high. technically. Now we need to see the PPO and the RSI turn back down. That's why I have, just like in the NDX and the S&P 500, I'm calling this potential divergence because I don't know how much higher that IWM is going to go. If it goes up here, let's say another couple, 2-3%, and then reverses, well, that's going to be a pretty powerful divergent high. You'll see the negative divergence confirmed once these turn down and prices turn down as well. It could happen tomorrow. It could happen next week. Could happen a month from now, and still have divergence. And if those divergences are taken out, like I said, more power to the small caps. They had divergence right here. It played out for correction, but at this point right here, took out those previous highs. The RSI took out those previous highs. No more divergence, voila, and that led to a nice rally. I wish in hindsight I could tell you I caught, well, actually, to be honest with you, it wasn't much. We went up to about right here, and we've been in a sideways trading range, as I point out. So there wasn't a lot of meat. It seems like, this market, I know to many seems bulletproof, but it's really, at least the small caps have gone nowhere. The S&P 500 has gone pretty much nowhere for the last few months, that is. What's gone up are the tech stocks, and just a handful of them at that. So there it is, guys. Hope this helps. The video was longer than I wanted it to be, covering just a handful of charts, but I feel it's important to share my views, right or wrong. That's the way I see things. And again, this market can go to the moon without me, but as long as it's doing so on a divergent high. Same thing with stocks. I don't take stocks that break out with clear negative divergence in place, that break out of bullish chart patterns or to new highs, as I don't do it, going long. I prefer to see the bullish divergence on longs at the bottom. But all right, let's wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.